Okay, so in the previous part 1 of overhead rate video, we had gone through part of this PowerPoint, and we got through here where we summarized that our estimated overhead for Charles Furniture is $100,000, and they estimated that they would use 8,000 direct labor hours. And so to get their predetermined plant-wide overhead rate, they took the 100,000 estimated cost divided by the 8,000 estimated direct labor hours, and that came to $12.50 per direct labor hour. Then all during next year, as they're applying the overhead, they look at each job, how many direct labor hours there were, multiplied it by $12.50. So by the end of next year, let's say, they turned out to have 8,100 direct labor hours. They had estimated, they thought they would have 8,000, but what if in reality they ended up with 8,100? So all of those 8,100 direct labor hours were multiplied by the $12.50 rate and applied to the different jobs. So the 8,100 times $12.50 is 101,250 that we actually applied to jobs. Okay, more than what we thought would be the total cost, because we ended up having more direct labor hours than we thought we would. Okay, when we apply overhead, we debit work in process and we credit the overhead account. So when we take overhead in, such as indirect materials, indirect labor, rent, insurance, all those other things, we're debiting overhead. The actual amount of overhead that we're paying for is debited to overhead. But as we apply the overhead based on our overhead rate, we are crediting overhead and debiting work in process. And whenever you debit work in process, of course, you're also having to put that on the job cost sheet, or debit your little job T account if that's what you're using. All right, so in this example here, we're taking a look at what if we have multiple different products, but we have lots of each of those different products. Not every pizza is a total one-of-a-kind custom thing, okay? So we have some thick crust pizzas, some thin crust pizzas, and some deep dish pizzas. So we want to figure out how much overhead should go into each of these 3 different types of products. So first of all, we figured out all of our costs that we estimate our costs for the period. Now in this case, it's not for a whole year. They're figuring out 1 month. Okay, so depreciation on the pizza ovens, rent, utilities, other things that are part of overhead, and we're adding all of that up. So on average, we figure if we averaged everything out, it'd be $8,000 per month that spent on overhead costs. Okay, and we figure that the direct labor hours per month is about 800. So to get our single plant-wide overhead rate, we take our estimated overhead cost, 8,000, divided by our estimated cost driver, 800. So that's $10 per direct labor hour that is going to go and be applied as overhead onto each pizza. So the different kinds of pizzas have different amounts of direct labor hours. So here's where you would not want to just say, how much overhead should I apply to each pizza and treat all the pizzas as if they were the same. Some pizzas take a lot more time to make that pizza than other types of pizzas. So we should, our rate is by the direct labor hours. Then we can look at the three kinds of pizzas, figure out on average how many direct labor hours does it take. So the thick crust pizza takes 10 minutes, the thin crust 6 minutes, the deep dish 15 minutes on average for our business. So how much of an hour is that? Well, 10 minutes, an hour is 60 minutes. So 10 minutes divided by 60 minutes is 1/6 of an hour. 6 minutes divided by 60 minutes is 1/10 of an hour. And 15 minutes divided by 60 minutes is 1/4 of an hour. Okay, so we're going to take the $10 per direct labor hour for thick crust times 1/6 of an hour. So the $10 times 1/6 is $1.66. The thin crust is $10 times 1/10 of an hour, which is $1. And the deep dish is $10 times 1/4, which is $2.50. So for every deep dish pizza that we make, whatever direct materials went onto that pizza, whatever direct labor, the quarter of an hour, the 15 minutes, goes on that pizza, plus the $2.50 of overhead that will be applied to that pizza, so that we know exactly how much that pizza cost us. So if the direct materials was $2 and the direct labor for 15 minutes was $3, and then we have this $2.50 for the overhead that we're applying, then we would have $7.50 of cost for a deep dish pizza. And then we would know how much is the minimum that we want to charge the customer for this pizza. And you don't want to just barely cover that product cost, because there's other costs related, such as marketing and accounting related costs. You got to pay for other employees who don't make pizzas. All that kind of stuff has to also be covered. So if it costs us $7.50 to make that deep dish pizza, then we're probably going to want to make sure we charge maybe double. We would have to look at our other costs, but at least we know that the product itself costs us how much it costs us. Okay, actual overhead, remember, is debited as it happens throughout the period to the overhead account. And as we apply it to the jobs, it's credited to overhead. Typically at the end of each month, we'll look at how many direct labor hours or machine hours or whatever at the end of each month for each job, multiply it by the rate, and that's how much we're going to debit work in process and credit overhead for what we're applying. So at the end of the year, we'll have the total actual overhead that we spent that year and the debit side. And we'll have the total that we applied on the credit side. If that difference between the actual and the applied is relatively small, we'll just close out the overhead account at the end of the year and put the difference into cost of goods sold. If the difference is large, we have a huge hassle to refigure the allocation of the overhead for the entire year. All of those jobs have to be recalculated. We're not going to get our money back because we already charged. So if we spend a lot more than we thought we were going to on overhead items, we already charged those customers. We can't go back and, hey, that thing you bought last June, you know, well, we need to charge you an extra $1,000. No, too bad. How sad. So the management people who didn't put enough time in and didn't figure out good estimates to use for our rate formula, those management are gone. They're history. Okay, so what does this tell us? That you need your management, or you're helping with the accounting, that as well. It's mainly management's job to come up with really good estimates so that you can be in this other paragraph where the difference is small. All right, so for Charles Furniture Company that we had looked at, their actual overhead, so the debit side of their overhead at the end of the year was $102,000. We had applied overhead, remember, 8,100 hours times $12.50. We had applied of overhead during the year of $101,250. So we have a difference between how much there actually was and how much we applied, which we're always going to have a difference. You're never going to be able to estimate it exactly, okay? You just want this difference to be small, okay? So the $102,000 minus the $101,250 is $750 difference. And that balance is sitting on the debit side. Usually in a T account, big number minus the small number goes on the side of the big number. So we now have a $750 debit balance in overhead. That's the difference between our actual overhead and what we applied during the year. Now, if you take $750 and divide it by the $102,000, you will see that is a very small percentage. So we're good to go with that $750. That is a good. If it is any more than 5%, if you take this difference divided by your total, and it's more than 5%, then you got problems. Okay? If the amount of overhead that you applied is more than the actual overhead that you have, then you have over-applied the overhead. If the overhead you applied is less than your actual overhead, then you have under-applied overhead. So when we look at this, back at this T account that we were looking at, the actual is 102, what we applied is 101. So we applied less than our actual, okay? So we under-applied overhead by $750. So what do we do with that? Again, if the balance is large, we have a huge amount of work ahead of us. And you'll be lucky if you don't get fired. Okay? If the balance is kind of medium, it's not huge, but it's not small either, we can allocate that difference to whatever is work in processes in there at the end of the year. We can see how